Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Hello, welcome back to the Investing Podcast. My name is Ben Nye. This is presented by Tusk Media. And today we're going to be talking a little bit about Nike. The Beaverton, Oregon company reports earnings tomorrow, Tuesday, December 20th, after the market closes. And today I wanted to talk a little bit about where expectations are and why I think that some of the expectations are more pessimistic than they should be. So for a little bit of context, if we look at slide 1 here, Nike has seen decelerating futures orders both in North America and China, and there's a danger that futures orders will go negative. Now, futures orders are a metric that Nike has historically used as a gauge for future revenue, but that, as we'll see, is becoming less and less relevant as a metric to gauge where Nike is. So that trend does not look good. Go to slide 2, we can see that last quarter, reported in September, Nike missed on North America futures orders, and overall they were slightly negative, with their one saving grace actually coming from Central and Eastern Europe, which is not typically a source of strength, and neither really is Japan. On slide 3, we can also see that the gross margin declines have accelerated over the last few quarters. So again, this is not good news for Nike. And so a lot of analysts are projecting that these gross margin declines are going to continue. There's the view that there's a big inventory overhang from the retailer bankruptcies that we've seen this past year with Sports Authority, etc. And the idea is that there's been so much inventory that's just been flushed onto the market from these liquidations that is resulting in a lot of gross margin pressure at Nike. And the fear is that that is going to continue. However, that's the bad news. Now I want to transition a little bit more to some more good news. What we see is, despite what we hadn't seen in futures orders, revenue is actually starting to accelerate. On slide 4, you can see that year-over-year revenue is now about as high as it's been in the last 2 years. So that's good news on that metric. And you can also see that the correlation between revenue and futures orders has deteriorated significantly. Just a couple of years ago, futures orders was a fantastic data point to look at revenue. The correlation was 89% between futures orders and revenue, going back on a 5-period basis and analyzing it that way. And now that correlation has dropped to 63%. So what we're seeing is that futures orders are increasingly a less reliable indicator of where revenue actually ends up going. And a lot of that is due to the fact that Nike is increasingly doing more direct-to-consumer selling, which is actually a higher margin business for them, but it does require some more upfront investment, which is why you're seeing a little bit more stabilization in the earnings structure. And Nike actually talked about this in their last quarter conference call. They said, futures orders continue to be an important and valuable aspect of our operating model, but the relationship between reported futures orders and reported revenue in a given quarter has become less correlated based on our evolving business mix. So as you saw in the previous chart, I went back and fact checked, and sometimes management portrays what they're actually doing in a different light than what's actually being accomplished. But in this instance, management was fairly accurate in their assessment in that quote. They continue to go on to say, the primary drivers of the contraction in Q1, I'm talking gross margin contraction, were several temporary or discrete items, including foreign exchange impacts, exit from the golf business, higher mix of off-price sales as compared to the previous year, and a shift of expenses from operating overhead to cost of goods sold. So, again, there's subtle reference to the sports bankruptcies when they talk about a higher mix of off-price sales. but then also other items which are not likely to repeat. So for that reason, they're actually seeing, while they're going to see contraction this quarter, they're expecting less gross margin contraction than they saw previous quarter. So you're starting a little bit of a less acceleration to the downside. You're still declining on gross margin, but not at the same rate. And so they continue to go on to say, at the same time, we continue to benefit from higher full price average selling prices, lower oil-based input costs, and the favorable impact of product cost driven by our manufacturing revolution initiatives. So what really sticks out to me there is higher average selling prices. That's very important because it demonstrates that Nike still has some pricing power in the market because they have a premium product which has benefits, has a brand benefit, has a product technology benefit to consumers that consumers are willing to pay up for. Now, a quick anecdote from my experience on Black Friday was that I purchased a $55 sweatshirt for $25 from a Nike outlet, which was an excellent deal for me, but hopefully we'll see less of that from a Nike investor perspective going forward. That was a Black Friday deal though, so it's difficult to read too much into that. Importantly, the overall enterprise inventory growth. Inventory was, again, a headwind for them, but the inventory growth has only been driven by a 3 percentage point increase in units, which is actually rather tame when you're considering their revenue growth is over 5%. So a 3% percentage point increase in units, and they actually saw a decline in North America units, as well as the value. So that's kind of the big picture from what happened last quarter from Nike. So now what's happened over the last 3 months since they last reported is that people are becoming more and more concerned with respect to Adidas and Under Armour competition at Nike. They're saying that the competition from Under Armour, the upstart, and Adidas, kind of the revitalized competitor, is going to really hamper Nike's growth rate, and it's also going to hamper gross margin because it's going to become a more competitive industry. So what we're seeing is what people are talking about peak athleisure, that this is a style trend and that Nike has benefited from it over the last few years, but that will decline. However, if we look at the data, if we look at the correlation data between Nike stock and the Google Trends data for interest in Nike, what we see is an extremely strong 0.89 correlation between Nike the stock and Nike as searched by Google. But what's particularly interesting is that over the past 3 months, we've seen a significant decline in Nike shares, while at the same time seeing a rise in interest in Nike to the highest levels it's ever been. If we look going back in each November, yes, we've seen some deceleration. Last year in November, the interest increased from 79 to 93, which is a tremendous percentage point increase. This year it only increased from 93 to 96, which is less of an increase, but still you're talking about peak Nike interest, and you're talking about a decline in the actual shares. So keep an eye on that. You can easily go and look at this data yourself by going to google.com/trends and then looking at Nike. On the next slide, we see the trend interest relative to Under Armour and Adidas. And what's interesting here, on this one, I looked at Nike by itself, Under Armour by itself, and Adidas by itself. So don't look at them relative to one another, rather look at them as how they progressed over the years. So what you can see is that Under Armour has been pretty steadily trending up over the last couple of years, and Adidas has spiked up just in the last number of quarters after trading off relative to Nike. So all three are at peak interest essentially, but for Adidas and Under Armour, they've come from a lower base. So is there renewed competition from the two? Yes, there is. I don't think anyone's disputing that, but the question is, how much is it actually accruing to the detriment of Nike? And I would argue that it's not accruing to the detriment as much as what a lot of the Wall Street naysayers are saying. And then if you look at the relative interest spread on Google, what you can see is that Nike to Under Armour is still, that has not changed that much. You're seeing a relatively steady relative interest spread between Nike and Under Armour. What is interesting is that the spread from Nike to Adidas has collapsed. Adidas used to be a 30, 40 point underdog relative to Nike, and that's closed the gap to about 10 to 20 points. So in the space of just a year. So that's very important, and it shows that Adidas, even more so than Under Armour, is the competitor to watch out for when you're talking about Nike overall. So keep an eye on that. What's also interesting is that the spread from Adidas to Under Armour has increased substantially. So Adidas is really the up-and-comer, even while Under Armour is getting a lot of the headlines for the coming competition. And we can see that in the last slide here, how much ground Adidas has made up over the last 2 years. So, but even so, Nike is still at all-time highs. So, when you're thinking about Nike, you know that the Adidas and Under Armour are coming to get them. That's point number one. But point number two is that this is not doom and gloom by any means for Nike. The stock is traded down substantially, and it's not like the business has changed remarkably. They are still innovating, they're still moving forward. This is a company that's been around a long time, and it's going to continue to be around a long time in my view. And they're going to be able to combat this competition. They have excellent products. I'm wearing one right now. And I would look for Nike to surprise analysts and the street when they report tomorrow afternoon. So keep an eye on futures orders, but especially keep an eye on what gross margin does relative to Nike's own expectation and what revenue does, because those 2 points are going to be the key thing that drive Nike stock in the future, even if futures orders garners the headlines. I will be live tweeting this from Tusk Media, Tusk Media's Twitter account at Tusk Media LLC. So if you want some quick data points from that, I'll also be updating the charts and tweeting them out tomorrow afternoon. Thank you for your attention, and stay tuned for a follow-up in a week or so. Thank you.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.